Good afternoon and welcome to our session on driving the low-carbon transition with 2-degree scenario analysis and disclosure. If you were focused on the first few words of the session title and we're aiming for something on electric vehicles and transportation, I believe that's across the hall. But hopefully this reflection, all the participants in the room are a reflection of what we're seeing, which is incredible momentum and focus on climate risk disclosure, analysis and disclosure. I'm Sue Reid, Vice President of Climate and Energy at Ceres. Really appreciate all of you joining us today. I'm delighted to be joined here by some really visionary thought leaders and actors in this space. So next to me is Curtis Ravenel, Global Head of Sustainable Business and Finance at Bloomberg LP. Among many, many other hats Curtis has worn, I've lost track. He has played a seminal role with the Task Force on Climate-Related Financial Disclosure, TCFD. I know that's everyone's favorite acronym now, but Curtis will tell us a bit more about his role there and the importance of taking these industry-led recommendations to take these topics, these issues truly mainstream. Next we have Simpson, who is the Investment Director Sustainability at the largest public pension fund in the United States, CalPERS, with about $330 billion in assets. Sorry, what's the latest figure? Okay, got it. Constantly evolving.
That's right.
This is true. This is true. Well, you should claim some credit, Anne, in terms of Anne is a longtime leader in this space. We're really fortunate to have been working for many, many years with Anne and with CalPERS, and to have you with us today to share an asset owner's perspective. And next to Anne is Simm, who is founder and CEO of Impax Asset Management, which is celebrating its 20th birthday, as I understand it. Ian will share, from an asset manager's perspective, what needs to be done and what Impax is doing in terms of developing tools and building on its long legacy of being at the leading edge of identifying and seizing opportunities with transition to a sustainable economy. Next to Ian is Peggy Smyth, who is the U.S. Chief Financial Officer of major public power utility, National Grid. And National Grid has been a long-time leader with regard to clean energy transition, from energy efficiency to being one of the first utilities in the world, and certainly the first in the U.S. to enter a long-term power purchase agreement for offshore wind, and leading company with regard to embracing energy efficiency and all of the opportunities entailed with that. So sharing a company perspective and a CFO perspective on climate risk analysis and disclosure. So with that, I would just like to state what is probably obvious to folks in this room, but I think worth taking stock of. It's 2018. The first one of these investor summits, as Mindy mentioned earlier today, was held in 2003. 15 years ago, it was quite a challenge, even though the science was decades old in terms of what was happening in terms of human-induced climate change. Getting these issues out there in the finance and investment dialogue is still a very, very new thing. And quite a number of you were involved in those early discussions right here at the United Nations headquarters. Excuse me? There we go. We could have a show of hands if you were here at the outset. I'm sure others are just being shy, Tim, but anyway. And it's really extraordinary when you take stock in 15 years period of time how much the landscape has shifted. And I think if you leap forward to 2017 and some of the really iconic, globally visible manifestations of the change through the majority votes on carbon asset risk assessment and 2-degree scenario analysis and disclosure at ExxonMobil, PPL, Occidental Petroleum, and near majority votes at quite a number of other oil and gas and electric companies. And of course, as Curtis will discuss more, the work of the Financial Stability Board's Task Force on Climate-Related Financial Disclosures, an industry-led task force putting out recommendations for investors and companies. It's extraordinary. These issues have gone totally mainstream. There's still a lot of work to do, and so really look forward to the dialogue today, hearing more from some of the thought leaders and actors in this space. So with that, I'll turn it over to Curtis to speak in particular to the TCFD's work. Thank you.
Thank you. Thanks so much. I'm just going to try to set a baseline for our discussion, really, and just provide a little bit of background on the TCFD and why we think it's important. You know, the TCFD was established by the Financial Stability Board, really driven from Governor Mark Carney, who wrote a great speech, for those of you who haven't read it, in September of 2015 about, tragedy of the horizons. If you're a geek and you love finance and you love trying to tackle these issues, it is really quite a tour de force. That really set the stage, and I think then having Mike Bloomberg join him in that are two sort of well-known mainstream financial players who legitimize and bring some credibility to an issue that many of you in the room have been working on for a very long time. It's great to have new messengers on that, but we do stand on the shoulders of all the people that worked in this room. You know, the idea was to really promote more informed investment, credit, and underwriting, and insurance and underwriting decisions, and better understand carbon-related assets in the financial sector. It's pretty straightforward. It is important to remember in the U.S. that the premise is we are transitioning to a low-carbon economy of this, and the question is, how smooth can we make that, right? And the governor's view and Mike's view is that this is dependent on good information. And bad information results in mispricing and poor capital allocation. So depoliticizing the issue and making it about good investment decision-making is really what the purpose is, right? We tried to come up with a structure that was what we would call consumable by normal people. So, governance, strategy, risk, metrics, and targets. That's bread and butter. Not create a separate process under which climate is this unique thing. It's not. It's like many other risks. It's complicated like many other risks. It's interdependent and all of that. But in the end, if you make it an additional burden on the board and senior management in a way that's different than the way they do business, it will never succeed. So we've got to be able to speak the language of the finance community, and CFOs like yourself, this resonates with them. We also needed to make it one page because attention spans are not there, Exhibit A. We worked for about a year and a half to come up with this one slide. There's a lot behind it, but it is consumable, I think, to a general audience, right? And I think really one of the things that does distinguish this, and it doesn't make it different, but just puts further emphasis on it than other efforts, is that's why we have this horribly clunky name, the Task Force on Climate-Related Financial Disclosures, and it really is trying to emphasize. I mean, much of the reporting out there was originally developed to talk about how companies impact society, the environment, and climate, which is very important. And they have migrated since to say, how does climate impact a company's financial performance? This is solely trying to focus on that and trying to connect those top piece of that slide, which is what we call transition on physical risks and opportunities in climate speak with financial speak, which is the bottom, revenues, expenditures, income statement, cash flow, et cetera. I don't think, to be honest, we're quite there yet, but we've started what I hope is more of a movement to connect those dots in a way that's consumable, again, to everybody. One of the key anchor, what I would say, pieces of that is this idea of scenario analysis. Again, not really a new idea, but just using Mike and Governor Carney has elevated that issue and made it to be a more central piece of this planning process. And it's hard because financial accounting, as we all know, is sort of a snapshot in time and generally looks backwards. And when we look forward, people get concerned and scared. Or is this guidance? What's the difference between scenario analysis and guidance? They are very different. And it's important to distinguish that and acknowledge that. It's also not necessarily easy, but one can start a journey by thinking, especially if you have long-term capital plans, what does this mean in a future world. If I got a 30-year investment, I need to be thinking a little bit about what that future might look like. Could be a 6-degree world. It could be a 1.5-degree world. Doesn't matter. It helps the board and senior management think strategically about how they want to pursue their strategy and manage their risks. And that's really, I think, the sort of key issue. What we're doing now is we're trying to sort of focus on the rest of our remit is around monitoring and encouraging adoption, full stop. And so instead of creating yet another separate report, we want to integrate our concepts into other reporting frameworks. That's financial and non-financial alike. We want to work with companies to help them adopt it. And we do want to advance this concept of scenario analysis, not really just for climate in general, but just in general good business management. And a lot of firms do scenario analysis a lot. They just generally don't share a lot of that for understandable reasons in some cases, but norms change. I like to quote Bob Eccles, who told me that, we have to remember that before the Securities Act of 1934, company revenue was considered confidential business information. So, we have to move forward, but there's a collective action problem here. People who do it and other people who don't, there's a first mover disadvantage. And so we need to get everybody on the same page, and we're going to talk today about what is scenario analysis and how it can help and not hurt. Thank you.
Thank you very much for that, Curtis, and for all of your leadership. I did want to say just logistically, there are seats in the middle of the room. This is the only slide deck we'll be going through. If anyone was concerned about not being able to see the presentation, please feel free to take the awkwardly situated seats in the middle of the room that might still be better than... And we'll keep rolling while that happens. So, Anne, tell us from CalPERS' perspective, you've been on this journey for quite a long time and certainly played a role in feeding into inputs for the TCFD's work before the recommendations came out. Tell us about the drivers with CalPERS' work on this and what's in the offing. Where are you taking this?
Thanks very much. And I just want to extend the welcome. Anybody who's huddled in the corner, we've got this lovely arrangement, which is a bit like being on a school bus trip. Curtis is going to be the driver. I'll be collecting fares.
My license is taken away.
No, but do please come and make yourselves comfortable. I feel badly if people don't have a seat. We don't tend to drone on for too long, but you might want to be comfortable. So listen, thank you very much to all of you for finding your way here. I think that's an extraordinary achievement. I, for one, have been lost at least 3 times, and hoping that everyone in the main room thought, oh, Anne's obviously taking a very important phone call again. Anyway, thank you very much to the UN Foundation, to the UN, to Ceres, and all the sponsors that make this sort of gathering a success. So, first of all, I think that the asset owner community, of which CalPERS is a member, owes an enormous debt of gratitude to Mark Carney for having the vision to articulate the tragedy of the horizon. In other words, that we're all operating in timetables that mean we can't address very long and sometimes slow-motion tragedy which is unfolding. We also understand that we have another tragedy, plenty of tragedy in investment. All right, maybe comedy as well, but tragedy, the other tragedy we have is the tragedy of the commons. So as investors, we all think that we can protect ourselves from risk by only holding a little bit of quite different things. And then when you face a risk like climate change, first of all, for CalPERS, we're so big and we're so long-term, we have nowhere to hide. We can't actually diversify out of the risk that climate... There's no place that you can put this huge sum of money and expect to earn returns for the best part of a century. And if you close the door at CalPERS in the morning, and we had to keep looking after our beneficiaries, paying pensions and healthcare, we'd have to be still doing a pretty good job at investment for close to 100 years. And the other little detail I think that's important is that we provide our members, of which there are close to 2 million, with something we call their CalPERS pension buck. And it looks like monopoly money. And we're not doing CalPERS currency. It's not Bitcoin, only Calcoin. Or it's just a little, looks like a banknote. But what it shows our members is that of every dollar that we pay out, and we pay out about $20 billion a year just in benefits, so cash, now, short term, really matters. 65 cents of that dollar comes from investments. So in other words, the safety and soundness of the wider financial system, the ability of the wider economic system to generate returns is actually essential to us being able to meet our purpose, which is looking after the pensions and the healthcare for all these public workers in California. So 2 things. The tragedy of the horizon, how do we look ahead to risks unfolding over generations? And also, how do we overcome the tragedy of the commons? And I think the work of the task force, which Curtis has just introduced to us all, is essential to this. First of all, because it gives us a shared framework. We've realized that one of the vexing responses from companies we find is, well, CalPERS, you say you would like that. Well, I'm telling you, that's not what other people think. We've got 101, a bit of this, a bit of that, and you don't agree, and oh my, best to do nothing. So the first thing that you've enabled us to do is to gather around a framework which is reasonable and can be articulated in a clear way, and something which is relevant to all sectors. I think it's very important in your recommendations that you didn't say, well, we think that this is ever so important for the following sectors. And you also didn't say it's just important for public markets. Now, we have private asset classes as well as public asset classes. We're also obviously thinking about fixed income on this agenda as well. So when we're looking at the total fund, we like the fact that you've developed a framework that works everywhere. So what have we decided to do? Well, the tragedy of the commons can only be overcome by us working in partnership with fellow asset owners and their managers. So it's been referred to a couple of times in today's meeting. But what have we done? What have you done, said Sue Space. Come on, explain, what have you been doing? One of the things that we've done is realised that in order to tackle the risk of climate change, we've got to work on a number of levels. But one of the most important is to turn off the spigot, or turn off the tap if you're talking from Britain. But actually the faucet, what's the name for it in different countries? But emissions are coming from business activities, and we own those businesses. So the point is we are in a position to do something about this. And we carried out a piece of analysis as part of being signatories to the PRI. They issued something called the Montreal Pledge just before the Paris Agreement. And it was, okay, well, have a look at your portfolios and work out what your carbon footprint is. So this was no simple task because we don't have the data. If we'd had your report 5 years previously, we might have been able to do a better job on the carbon footprint because we don't have the data. We had to sort of imagine, estimate, guesstimate, But anyway, we came up with a reasonable approach. What we found in that process was that for the 11,000 companies we hold a tiny piece of in 47 markets, less than 100 of them were responsible for the majority of the emissions. So that was a surprise. I certainly didn't expect us to find that. But what that then meant is we thought, if this is the case for CalPERS, because we have market weightings, we're broadly distributed around the world to capture economic returns, we're indexed. It's probably the same for other funds as well. So Ambassador François Delattre hosted a breakfast, which he mentioned in his remarks this morning, which was a very important occasion, because CalPERS was able to share this rather crude assessment that we'd done and share it with fellow asset owners and investors and say, how does this look from your portfolio? So what we've been able to do with the help of Ceres and their sister networks in Europe and Asia and Australia and the PRI and other asset owners and managers who've got involved is build an alliance, which we're calling the Climate Action 100+. The plus is so we can add other companies in. Because we expect of the 100, there will be a graduation program. Companies will, do what's needed, will no longer lead our attention, we'll say fond farewells, thank you and goodbye, and we'll bring some other companies in as well. As Mindy Luber of Ceres said this morning, we launched at the Paris Summit. Macron recognized this as one of the initiatives, which we were thrilled about. And we're just edging close to the 30 trillion mark in terms of investors who've signed up. So what have they signed up to do? We're asking companies to do three things. The first is to articulate the governance strategy at board level. We actually want to be able to hold boards accountable. If boards are there to be the stewards of, overseeing management, then the boards have to be accountable. We need to have climate competent boards. We need to have majority voting, proxy access, all the above. But that apparatus needs to be in place, and we, as the co-owners of the company, board accountability. So that's number one. And it's, I think, the first piece of your framework. It's very important. The second thing we're asking for is action. In other words, we want these companies to come up with the plan which is going to get their business strategy in line with the Paris. I think Rosina Birnbaum today showed very nicely what is the trajectory, the glide path for emissions. Glide path sounds charming. It's like a paper plane. We'll just throw it and we'll all come down. But actually, this transition is going to be messy and difficult, but we have to be fixed in our purpose and ensure that we support companies from short-term pressures, from raiders, from hedge fund activists, any distractions from actually keeping this long-term strategy. So we're asking for these plans. And thirdly, because how would we know whether all of this is in place, we're saying to companies, report under the guidance from the task force, which Curtis has just introduced. And that says governance, risk management strategy, metrics and targets. Now, I just want to dispel a little bit of the sort of, it's all voodoo about scenarios. Guess what? I mean, every investment advertisement you will ever look at or comply with says the past is no guide to the future. Really? So the future hasn't happened yet. That's why you need a scenario. If you think the past will be the guide to the future will we'd still be in the Stone Age. There was a lovely phrase, actually, at the launch of the Carney-Bloomberg double act in Paris, I remember, where some wit and wag said, well, we didn't leave the Stone Age because we ran out of stones. So this idea of things being different is actually the gateway to improvement, to evolution, to, the Sustainable Development Goals, which the Deputy Secretary General so eloquently referenced. We have ambition for things to be better, and that's the future, but it's the future we need to make. It's not a future we can just repeat from the past. So scenarios for an investor are ways to understand a reasonable person's possible futures for a company. But we're asking for these to all be set out, assuming that we've all agreed we don't want the planet to fall apart due to excessive temperature rise. So what we're saying is we agree well below 2 degrees, which is what Paris agreed. So at which point, and you can look at some companies like BHP Billiton who've already jumped in and said, okay, we're trying this, and have produced 3 possible futures for investors to look at. Now, that's actually very interesting, because then you've got something to talk about in terms of capital allocation, strategy, risk management, and all that sort of stuff. So my final observation, Curtis, your acronym. What's the name of your task force? This is a data guru.
TCF. It's
the
FSB gave us the name.
TCRFD. Task Force on Climate-Related Financial Disclosure. Means you are the TFCRFD.
Yes. We wanted to make it more complicated. That's right.
I'm just saying,
Yeah.
You could have. It's like Scrabble. I'd like to open up a Scrabble challenge to your task force and say, without the benefit of any vowels, somebody is going to have to take TFCRFD and turn it into a jingle or a rap or a word.
That'll be our first order of business.
Mnemonic, that's the CalPERS contribution. All right, well, Thank you for the work you're doing. It's incredibly important. And I think for all of us, it's, what's that? I wrote it down. If not you, then who? We own these companies. And if not now, when? So today it's time to get moving. Thank you, Curtis.
Thank you.
Thank you, Anne. And thank you for airing the very little discussed element of how odd of an acronym TCFD is, but it's still... No, it's still a fabulous one.
Data discussion accuracy.
There's creative hyphenation and so forth. Ian, from an asset manager's perspective, has been engaged in developing tools and so forth. Tell us about your experience with climate risk disclosure and both the risk and opportunity side of the coin, because I think it's often neglected that the TCFD recommendations are just as much about managing, addressing the risk side as identifying and seizing the opportunities.
Great, thanks, and good afternoon, everybody. This is clearly a very popular session because everyone wants to know not just who, which is obviously us, but how and why. And so I'd just like to touch on the how in a bit of detail. So Impax has been talking to institutional investors for 20 years about the opportunities in clean energy and energy efficiency. And it dawned on us maybe 10 years ago that there was a consistent question here, which is if clean energy is the answer, then what is the question to which that is the answer? And so that got us into thinking of where these opportunities fit in a mainstream asset owner's portfolio. And post the financial crisis, it became pretty clear that asset owners were really on the lookout for the next area of systemic risk. And so it was pretty logical to start thinking about clean energy, energy efficiency, as part of the hedge against the systemic risk that might be called climate change. When you look at the IPCC report from 2013, you really have a wake-up moment, which is that mathematically, climate change has moved from uncertainty, which is we haven't got a faintest idea what is going to happen, so rationally we should just do nothing about it, put our heads in the sand, to risk, which is the mathematical signal that, we can wake up and use our tools to try and model certain futures, because the narrowing of the range of options has made that rational and opened up some possibilities. So when you move from uncertainty to risk, scenario analysis really is the natural entry point, because as those of you that know the work of Peter Schwartz at Shell in the 1970s and 1980s, that was the team really that, in the modern age at least, invented scenario analysis and came up with that name. Then you know that's the tool in which you can start to map out plausible futures in quite an uncertain world. And so that got us thinking about how, as a major asset owner, you should be looking at climate change risk and coming up with actionable strategies for what you do with your portfolio. We very early on distinguished between what's now referred to as transition risks from physical risks. And physical risks, up until recently, I think one could look at insurance markets and diversification as the natural risk management tools. That's probably in doubt at the moment. But transition risks were probably the more important area to be worried about because of the relatively short time frame. Governments were quite likely to act over 5-10 years to put in place policies to try and mitigate and reduce damage and ultimately to adapt. Yes. It's obviously a UN signal I should shut up, but I haven't had my 5 minutes yet. So we focused on transition risks, and we very quickly realized that to be actionable, the scenarios would have to be suitable for assessing the potential impact on financial statements. So profit and loss accounts, cash flow statements, and balance sheets. And so if your management plan needs to be driven by potential impact on financial statements, you then need scenarios which are based on metrics that will impact, or you can see the connectivity to financial statements. And so it's one of my concerns about the current status of this debate is that everyone's talking about scenarios of a 2-degree world or a 1.5-degree world. In our experience, it's very difficult, if not impossible, to tie a 2-degree world back to financial statements. You need some intermediate factors, intermediate metrics. And so bearing in mind that we started our scenario analysis work 4 years ago, so before the wonderfully named Task Force on Financially Related Climate Disclosures was created, and we were therefore operating in somewhat of a vacuum, we decided that the best intermediate factor, if you like, was what we call carbon price. And a carbon price essentially is a manifestation of society's determination to change outcomes, right? So governments will put in cap and trade systems, or they will tax fossil fuel supply or consumption so that greenhouse gases are reduced. And so our scenarios have been based on a set of plausible ranges for carbon prices around the world and a set of plausible timescales for those carbon prices to be implemented. And so one of the points I'd like to sort of leave you with in this discussion is that it's it's actually quite useful to talk about carbon prices and run scenarios around that, compared to trying to run scenarios around where the planet may end up in decades or possibly a century from now. Because if you do that, then you can actually come up with actionable models. The second thing we decided to do was not to try and solve for all factors at the same time, because this is a phenomenally complex issue. And if we got bogged down in the complexity, it would be very easy just to sort of get stuck in the swamp. And so we made some highly simplifying assumptions. We've assumed in our models a global carbon price. We're never going to get a global carbon price, but that allows you to make a model. We have assumed that certain industries have got quite significant pricing power and should be able to pass on the costs of higher energy price to their customers, and therefore financially, at least in the short to medium term, they probably have quite limited exposure. So we've ignored those industries. That does bring us back to what everyone talks about, which is mainstream energy, utilities, basic materials, as the places that typically have got weak or zero pricing power, where they really are financially most exposed. And finally, we have decided that our simple model needs to be dynamic. So we need to update the scenarios periodically, and we think every 6 months is about right, because this agenda is changing with that sort of periodicity. And we've also provided in the modeling for getting a better model. So the simple model works now, but it's not perfect. It allows us to come up with some actionable results, but we are determined to improve it. And so our research is carrying on to sort of bolt on bits of the model to make it more sophisticated, but at least we've made a start. So I'm probably running out of my few minutes. So just to cut to the so what, we have been running for the last 3 years scenarios for climate change transition risk, where we're using carbon pricing with probabilities around level and year of implementation as impacting those major sectors that I just referred to, and coming up with a metric for value at risk. And then we've looked at the degree to which that value at risk is not priced in. And if it's not priced in, where we've got conviction that it's not priced in, we've run some portfolio optimization tools around taking some money off the table. And then the final crucial step is, if you're going to take some money off the table in exposed assets with irrational pricing, then you want to be very careful about where you deploy that divested money. Because if you simply spread it around the rest of your portfolio, you will probably be unwittingly introducing additional basis risk. For example, a step back from energy price factor risk, which many, if not most, asset owners want to preserve. And the secret of that, which is in our white paper, which is on our website, is switch from fossil fuel to energy efficiency exposure, because you can thereby preserve your energy price factor risk. I think that's probably enough for now, but I'm happy to go into more detail if you like later.
Great. Thank you so much, Ian. And hopefully we'll have a chance to dig a little bit more into some of those details momentarily. Peggy, from a publicly held utility perspective, I'm not going to put you on the spot to say whether or not you agree with PG&E CEO Geisha Williams' assertion that California is at the very leading edge in terms of all of this for National Grid, which operates in the Northeast and in the UK. But from a company perspective, wrangling with this, how are you approaching it, including the element of scenario analysis?
Well, thank you, first of all, and good afternoon, everyone. And I have to say that I really feel honored to be here today. I'm a native New Yorker, and I've witnessed the greening of New York City that started under the leadership of Michael Bloomberg and has continued on. And so I feel honored to be invited to this task force, which he has been leading. And what I'd like to just cover very briefly is just National Grid's views with respect to climate change and sustainability, and then how the TCFD recommendations pertain to National Grid, and then lastly, the collaborative approach that we've been taking with respect to scenario analysis and disclosure. So if there's one thing I do want you to remember about the discussion this afternoon is that we at National Grid do support the recommendations of the TCFD, and we are committed to collaborating with our peers to develop an industry-wide climate-related financial disclosure mechanism. So I'm going to tell you a little bit about National Grid and with respect to our views on sustainability and climate change. So first is that National Grid believes in the climate, in the science of climate change, and that global warming is real. Our leadership and our board view this as a top priority. We've set goals to reduce greenhouse gas emissions 45% by 2020 and 80% by 2050. We've built a cost of carbon into our capital appraisal systems, and we've publicly supported, and we continue to support, the Paris Agreement and the 2-degree scenario analysis. We, as the system operator in the UK, have been preparing scenario analysis and publicizing it since 2011, and it's our intent to continue to be a leader in this area. And lastly, that we support robust and transparent disclosure of climate-related risks and opportunities, and that's evidenced by the fact that we just received an A rating by the CDP for 2017. So you can see that we are committed to operating in an environmentally responsible manner and to meet the goals and desires of our customers and our regulators and our investors, and communicating the progress against these goals and objectives, because it makes good business sense and is also the right thing to do. So, but we recognize, as Curtis was saying, sustainability goals and carbon reduction goals and climate change goals, the financial reporting aspects associated with those, it's similar to any type of financial reporting that we have to do. And there's challenges in terms of making sure that we have standard metrics and that we can come up with metrics, and that it creates a transparent playing field across all the members that will be reporting. And that's why we see real value in the TCFD recommendations, and that's why we would like to continue to be a leader in this area. And that's why I'm here today, to listen to you and to learn and to see how we can all become more transparent and more communicative in this area, as well as to meet our ultimate goal, and that is reducing carbon emissions is the ultimate goal of everything. So from how does the TCFD pertain to National Grid? So the TCFD calls out two different types of risks that exist. First is climate risk, and the second is transition risk. So from a climate risk perspective, we are utility. We are located in the Northeast. We have a lot of turbulent weather that we experience. And Geisha talked about the bomb cyclone. It started out as Superstorm or Winter Storm Grayson, but then the name changed suddenly to the bomb cyclone. And I actually looked it up to see what that actually meant, because I had never heard of that either, and it means a winter hurricane. So the storms that we're experiencing because of climate change are more intense and more common as well. And this hinders our ability to provide safe and reliable and cost-effective service to our customers, and we have 20 million of them in the Northeast. So then you look at Superstorm Sandy. How many here were in New York City when Sandy hit? So you know the havoc that it wreaked to this city. From a personal perspective, my parents, I grew up in the Rockaways, and that town was devastated. It's part of New York City. My parents had lived in the same house for 60 years, and their house was destroyed. So we have assets that are located underground, near streams, oceans, et cetera. And so that is a risk for us that climate change has created. From a transition risk, then, energy policy is changing. And we talked about it, there's a lot of discussion at lunch with the integration of renewables and storage, electric vehicles, and that creates both risks and challenges for us from an engineering perspective and a business perspective that we're focused on. So the approach we're taking, though, is similar. We've heard some comments today on the panel. It's just a collaborative approach, right? So we can't do this all on our own, and we're looking at how can we best work with peers and other stakeholders. So internally, we've taken an approach, UK, US, across many of our different functions. We have communications, we have sustainability, legal, operations, finance, UK, US, all focused on getting more knowledgeable and in the areas of scenario analysis as well as financial disclosure. From an external perspective, we work with many different leading organizations. In the UK, our group finance director, Andrew Bonfield, has been a member of the His Royal Highness's A4S committee. He's on the CFO network. And in the U.S., we are working with the EEI, who's developing a common framework for disclosing climate-related risks here for U.S. energy companies, electric companies. So from a scenario analysis planning, we also, as we said, it's not a forecast, it's a framework for looking at the future that's very unstructured and trying to put some structure around it to help us model where we need to go. I talked about the fact that we have been creating scenarios in the UK since 2011 in our system operating role. And that, again, is a collaborative approach. We have about 400 stakeholders each year that get involved in that process. And the results of our scenarios are then used by academics, used by government, used by other business leaders, as well as used by National Grid that help influence how we're designing our systems for the future. And again, they're long-term systems. So in summary, we publicly supported the recommendations of the TCFD in the past, and we continue to do so, and will commit to continue to work with others to understand then how we get the financial disclosure requirements right. We are in the early stages, though, too, just like many other companies, and it's going to be a learning process, but we're committed to looking at best practices, adopting them, and being a leader in this area to bring value to our customers and to our investors. And lastly, from an organization perspective, from a National Grid perspective, all 26,000 employees, we are taking climate positive action, and we believe that helping to decarbonize the environment is the biggest contribution that we can make as a company, and we're committed to do that. And that's why we have all 26,000 of us that are focused on reducing carbon emissions 80% by 2050.
Excellent. Thank you.
Thanks so much, Peggy, for, among many other things, clarifying a common misperception that that forecasting and scenario analysis are analogous when they are quite distinct. And so I think we've just heard a lot about a growing cadre of investors, including asset owners and asset managers, companies and thought leaders who understand the value proposition of climate risk assessment and disclosure that's grounded in 2-degree scenario analysis and takes stock of the global commitment under the Paris Agreement to global decarbonization. I want to put a follow-on question out to the panel. What do you see as elements that are driving uptake of this? Not everybody gets this yet, right? There is this growing contingent, but it seems to vary by sector. It seems to vary in terms of understanding of the various risks, transition risks, liability risks, physical risks. But what are the drivers that are spurring uptake, and what else is needed to spur uptake more comprehensively?
I'd like to answer the question in a slightly different way, which is I think there are barriers to uptake. And one of them is that this wonderful work has the status of being voluntary. Now, I know you can't say that, but you're delighted to be voluntary. That was your mandate. But from an investor point of view, we're looking at the whole global apparatus of corporate reporting, and it's the day job of FASB, US GAAP in the US, and the International Financial Reporting Standards, lovingly looked after by IASB in the world. So the big question for us is, how are we going to get this type of reporting connected to what companies do as part of their normal cycle of financial reporting? Because one, it's inefficient for the company to have to do 2 sets of stuff. And from an investor, we have limited time and we want to focus attention where it's useful. We really want to see the dream of a common language being realized. And there's nothing in the work that you're doing which is outside what I understand in a simple way to be what the purpose of accounting is all about, and basic principles like materiality, like contingent liability. And also, we had 100 years to develop the accounting standards that we have, and they're still horribly imperfect. So let's make sure that we're not looking at this just a few months in and saying, gosh, why hasn't it been adopted? So one, it's voluntary, which means the only way that companies, thank you, National Grid, for everything that you're doing, and the other companies that are taking the lead, but to be the first mover and to be putting in the time and effort, you've got to be very sure you've got your investors behind you. And that raises the second problem to take up. Sorry, I'm a bit doom and gloom here, but I think if we can understand what the barriers are, we can think about how to overcome them, be practical about that. The second problem is the tragedy of the horizon. Many of those active in the financial markets are on short-term tickets. So, one way I've explained this is, we think of there being shareholders or share owners, as we like to say at CalPERS to emphasize ownership, but we really have three categories. We have owners, we have traders, and we have raiders. And companies have got to survive the capital markets in that current form, and we, the owners, have to hold on to that long-term strategy. And we've seen hedge funds jumping in and prompting rejigging sustainability strategies, putting people on the board, spinning off of assets. So the question is, how are we going to protect a long-term transition strategy in a market where you get eaten alive for not performing in the short term? So I think if we can be honest about those two things, how much progress can we make out of it being voluntary? Secondly, how can we overcome short-termism? I feel we'd be in a different... And Curtis, you can't answer the voluntary part because I understand you've done the job you were asked to do. Thank you. And voluntary was the job description. So it's not a criticism, it's an observation.
See that light touch?
And thank you. And I think, fortunately, in the absence of requirements, and those are being discussed now, both from different country jurisdictions, and also something in the sort of quasi-regulatory realm of stock exchange listing standards and so forth. There are a range of opportunities to move down that line. But fortunately, the Climate Action 100 Plus initiative that you mentioned earlier and has been discussed today is a way to move forward in terms of driving uptake in the meantime, right?
Sorry, just ever so quickly. What I'm saying is that the investors who are working with the companies have got to be really realistic that there's another part to the job. And that is to protect companies in building out and then be able to stick with the long-term strategies that are needed. So when you sign up for this, you have to sign up for working with the companies as partners and beating back the pressures of short-termism. And the other part of the job, I think, is we have to be a voice with the financial reporting standard setters so that they come to know and love this work and understand that it really does add value for investors. And ultimately, we need integrated reporting. That's...
Yeah. I'll just add on to the other side of that coin just quickly is, it helps to have the whole capital chain involved, and when you have the FSB asking for this, it tends to motivate. That's your regulator for the financial community. It tends to motivate them to get engaged. Right. Number one. Number two, that for companies, I think they do. To Ann's point, to put a finer point on it, they want the pressure relieved from them, the short-termism, and it is a great planning tool. And if they can get assurances from the investors that they will be given the room to do that in an effective manner, that's a win-win. And for some of the companies that we've spoken to who haven't really done scenario analysis before but have begun to, they actually find the exercise useful. Internally, believe it or not. There's that too. So, there is a lot to look at if we can get our arms around it to not see it as punitive. We really can't have another check the box exercise. That just pisses everyone off.
And the scenario analysis, it's a great tool and it's good that many people are learning it because it's not just for climate change. Right. It can help you in many other areas. And I think also what is really key is you have to have the commitment and the backing of your board and senior management. Yeah. Without that, you will not be successful.
I think there's two really unattractive extremes here that we may end up with. One is that regulators step in and try and prescribe exactly how these scenarios should look in a pretty granular fashion. And by definition, they will fail because this is a fast-moving situation. Regulators won't be able to keep up. The other end of the spectrum is that everybody's doing their own scenario analysis, and the deluge that will be required of data requests for companies will just be unmanageable. And so somehow we have to find the sensible middle ground. And I think it really is a time for the people in this room who are active in the debate to deploy capital to get together and try and hammer out what some useful parameters are to define the boundaries of scenario analysis. And so almost more urgent than anything else in this debate for people who come to these events to sit down and try and work that out. And from our perspective, I think what really makes a difference is if the companies just can come up with some very simple data points. Even just 2 data points will transform analysis. So for example, if a company was asked to demonstrate the impact on its balance sheet of a $40 a ton carbon price across its jurisdictions and, say, a $60 a ton carbon price, we as financial analysts can do an awful lot with that data.
Doesn't mean you believe that there will be a $40 price or a $60 price.
Yeah. Yeah.
And it also helps when you're...
That's a forecast.
It also helps drive innovation with your suppliers. Because if you're looking at your emissions, you're also looking at their emissions, and you look at the whole manufacturing process and production process, and it creates this really nice virtuous cycle of everybody focusing, and we believe it reduces costs.
Absolutely. Absolutely. I'd love to dig into that a tiny bit more, and then we'll have the opportunity to take just a couple questions from the room. We got rolling a little bit late, so we won't have a huge amount of time for room-wide Q&A. But building on that piece in terms of, scenario analysis and the outputs that are then disclosed are only as useful as the quality of the information and the assumptions that are going in and what's disclosed, so you can have the tools that you need to assess and factor into investment decisions. And this is setting aside even companies getting value out of the work to understand how to manage risks and seize opportunities. I can't help but put in a plug for some of the work Ceres has done in terms of developing a framework for 2-degree scenario analysis for the oil and gas sector that was released last year with Amy Myers-Jaffe out of UC Davis. We have one for the electric power sector in the works with Michael J. Bradley, who I think may be in the room, and should be ready in months. And we're working with electric power companies, among others, in the development of that, including National Grid, of course. What other tools are needed? And I'd love to offer up an opportunity in terms of how you ensure you get that quality scenario analysis that you need so that it's actionable, it's actually useful.
Yeah, something we've been talking about with some of our sister funds is this question about progress. The 4-part structure of the task force is logical and it all hangs together, but we want companies to begin by making a plan for how they're going to work through it. It's not good at this stage, I think, to throw your hands up in horror and say, oh, scenarios, where do they come from? Is this, some chew on peyote and ideas will come to you. How is that all going to work out? I think if you work your way through it, and I think, that Peggy's point about the board and senior management being behind this is why the first point that's useful is governance. So sorting out the board's role and responsibility, the division of labor with management, step 1. Step 2, risk management, gee whiz. I mean, the things that Peggy was just talking about, you can run through that question about risk management and check whether your impact, direct and indirect physical risks and other risks related to climate. And then strategy. Let's assume you don't, all right, there's the thing about will you or won't you get carbon prices, at what price, in which markets. But we already have the Paris Agreement. And I would say that, a data point that comes out of that is there is now a budget for the tons of carbon and carbon equivalents, and the industry that you're in is going to have to achieve some portion of that 80% reduction. And that's why we're focusing on the Paris goal, because that's here. That's been agreed, absent one country's intention to pull out at some point. But so I think there's enough to be going on with that. So I think getting started is the most important thing. I also want to thank Ceres for the work that you're doing, but also the European network, the Asian network, the Australian network, PRI, in the Climate Action 100+, and you can go to our website, Google that type of praise and it'll pop up for you. You find out more about how we're getting organised, but we're dividing up some of this work between us so that it will be helpful to everyone. But I think also, Curtis, the fact that you have a second wind. You have a second wind yeah, you should talk about it, but I think it's very important that you haven't just sort of dropped this tome onto everyone's desk and said, goodbye, now you're on your own. You've actually got some working groups underway, and that will help. So maybe you should say what you've got.
And I'd like to, and we should try to open it up to this. One of the things around scenario analysis is we kind of ran out of time at the task force before the recommendations could be totally the way that maybe I would have liked to have seen it, which is to Ian's point around scenario analysis. The way we wrote it was to provide flexibility to companies, and the companies on the task force felt very, very strong about having that flexibility to not be prescribed a scenario analysis, a particular 2-degree scenario analysis. The investors did not want that, to be frank, because if you have a bunch of bespoke scenario analyses, and then the companies don't disclose some of the assumptions because they're confidential, then you're just stuck where you were. Yeah. So, you either got to use a baseline scenario analysis and tell us what you changed, or disclose everything about your underlying assumptions. And I think we have some problems. The only way that scenario analysis will be useful at that point may be to the companies, but it will not be useful to the investors. Right. And that's going to be a problem. Right, and so we definitely have some work to do, and what our hope is there are a number of working groups in certain sectors trying to sort of tackle this and say, how much of this is really confidential business information? Can we get on the same page about sort of a baseline scenario that we all use? Yeah. And the problem is, though, utilities want to use the same one that the oil and gas companies are using because of that interdependency. So you got, we have to get there at some point. And it reminds me of Black-Scholes and how everybody uses Black-Scholes for option pricing, even though it's not the best option pricing model, because everyone uses it anyway. And then you get baseline bit, and you pivot off of that. And, I think that directionally, I don't, and this is a personal opinion, not I'm taking off my task force member hat and saying, I think you've got to get to a baseline scenario. I think particularly in the energy and transport sector, you need to use IDA and so on and so forth. So you've just got to start somewhere that's common. Right. Instead of start somewhere that's different and then try to go common.
Yeah, start together.
Yeah.
We just have about 5 minutes left and do want to open it up. And I think we're going to disregard, there's a system here, but we'll disregard that. We'll take a couple of hands, a couple of questions, and then pithy responses from the panel. So, Ted?
Several questions.
Yeah, I'm going to take 3 right together and then put them to the panel. So, Ted, and then Tracy, and Stan. Oh, sorry.
I want to hear about how you can square up what I hear are the facts of the environmental performance of that proposal versus the 62 other proposals. What you presented to us, because I hear you doing some great things operationally, but it seems like a bit of a disconnect for me.
Wait, we'll take 3 questions, and I'm sorry I didn't provide this guidance. If you could introduce yourself when you ask your question, that would be helpful.
Tracy River with CBIS, just building on Curtis's comment, my burning question coming out of the Paris Agreement and everything that we heard today is that 2 degrees is not enough. But our whole thrust of engaging with companies and driving the disclosure is getting that 2-degree scenario assessment. And should we, as in our ask of a range of scenarios, really ensure some baseline aggressive scenario that's 1 degree or 1.5 degree earlier on in this process, so that we're not doing too much readjustment later on, because if 2 degrees is not enough and everybody's focused on 2 degrees, where do we stand now?
The phrase is well below 2 degrees.
Yeah.
And Stan.
So Stan from Smyth Investing Initiative. One question on the mismatch of time horizon, because if you see scenarios, they become materially different after 5 or 7 years or more. And the most active equity investor, they will turn their portfolio every 20 months on average. So there's a kind of mismatch. And so, yeah, I be interested in how did you deal with this question, for instance, at TCFD or within Flatverse, and what would be the responses?
So I'm hearing a couple of questions related to sort of general metrics and calibration of scenario analysis, including 2 degrees versus well below 1.5, time horizon question, and then a very specific question that you can't totally disentangle from all of this about a particular project and the GHG and other equation in terms of business planning and investment. Panel.
Just on that, if you go on to National Grid's website and you Google future energy scenarios, you'll see that we model 1.5, 2, 4. There's a whole range of different scenarios. And on your question, that was not National Grid, that was another utility company.
Good answer.
So let me just comment on the other two questions briefly. I think in terms of the 1 degree scenario, that's absolutely valid, as Peggy says. It's just a question of what probability you put on that. So have a 1 degree scenario, but maybe realistically the probability of that is pretty small, but do it. And on the question about time frame, then this is why we focused on the transition risks rather than the physical risks, because it's transition risks that are going to manifest, we think, in the next 10 years. When you use your discounted cash flow, that's when the bulk of the net present value is to be generated. And we've seen from the coal industry that value could be destroyed very, very quickly if investors anticipate changes 5, 10 years from now. So I don't think there's any inconsistency, but you just have to be careful that you're not left holding the baby when everyone else is running.
On Stan, your question about the long term, I think the way we think of ourselves at CalPERS is that we're permanent. And there's something really important when you're engaged in a company to say, we'll be here next year, and the year after, and the year after, and the year after. And I know Craig Rines is here, our head of engagement, and I think we won a proposal at a company, what was it? I'm thinking it was a REIT, five years in a row. Craig still turned up. So this is something for us to take very seriously about the divestment movement, is if there's this idea that we're running for the exit, you lose that ability to hold their feet to the fire. Sorry, I don't mean we need to do that with National Grid, but if we're committing to this transition strategy, we have to just say we're not going away, and we're not going away until this job's done. So not even long-term, permanent, I think, is the way we'd like to think about it.
And if you look, as I mentioned, if you go onto our website and you look at our future energy scenarios, we update them every year. The assumptions are changing. As electric vehicles, the take-up is taking up more than, at a faster rate than what we had assumed in the past. They're updating. You're not going to get perfection.
So thank you so much for all of that. Thanks. I'm sorry we didn't have more time for questions and answers. We have run up at the end of the time. We have a pretty grueling schedule, as others have noted. 3 o'clock we resume in the ECOSOC chamber. In the meantime, please join me in thanking this incredible panel.